Facts. Stories. How you use them.
T-minus 3, 2, 1, 0, and liftoff.
Hello again. Tom Ellsworth, the Biz Doc here, and got my black cherry vault in my favorite Yeti mug with the lion smiling right at you. Recently, you guys were asking me a lot of questions, and they came into a loop. People were asking about, look, how many companies are actually on the stock market, and how many were there before, and why does it seem like there were a lot way back in the past? So I dug that up for you. I figured do a quick case study of what has happened to all the companies that were on the stock market. So when we take a look at the major U.S. stock markets, you have the NASDAQ and the New York Stock Exchange. New York Stock Exchange, you can go to New York and you see that big bronze bull. People take pictures of themselves with the bull in front of the stock market, the American flag, and the very stately building with all the columns. Yep, that's what we're talking about. You have our stock markets here in the United States. So comes the question from you all. How many companies are public, traded on the stock market today? About 4,600 of them. And why was it 8,000 in 1996? An alert viewer wrote that question, and that is really the question of the day. How is it we only have this many on the stock market and there was 8,000 in 1996? What happened in the last 27 years? Well, let's dive in, and that's the topic of the case study. First of all, let's take a look at the trend. And what we have here is a mountain chart that shows you, goes back to 1975, it grows and grows and grows and grows, and there it is, 8,000 companies in 1996. And this is from the World Federation of Exchanges via World Bank. So we went out and got real data to dig it up and are crediting the fact we got it, and this was actually built by our friends over at Charter. And so there were 8,000 companies in 1996, but since then, 43% are no longer there. Now, there's been a little uptick recently in the 2020s, as you can see there. Actually started about 2018. And there's 46, 42 to be exact, right at the end of 2022. Last year, I think there was about 24 more. Now, part of that little spike there is a thing called SPACs. Many of you read about SPACs, Special Purpose Acquisition Corp, where people could just roll out and go public rather than the longer IPO process. So nonetheless, we are up a little bit, but still down 43% from the peak. Where did they all go? What happened to them? Well, what are the causes of this shrinkage? Well, first of all, people believe it's the rise of private equity and VCs. Massive capital pools available from venture capitalists. So if you have a company, you could keep getting giant investment from venture capitals, sequential rounds, and then PE could come by you. So why do you go public in the first place? Well, you go public to get access to a big stack of capital, and some of that is given to your investors that got you going to where you are today. So going public is, number one, a liquidity event for early investors, and then number two, a vehicle for the public market, the retail investors, and others to make money and invest in it, and it goes into 401ks and IRAs and things like that. But when private equity and VCs come out there, it gives big access to pools, so you could delay going public. You could actually be private for a long time. Also, there's what they call access to secondary markets. If you made an initial investment in a small company and it went really, really well, and some point in the future, somebody says, hey, I'm going to invest $50 million in the company, 20 may go into the company, 30 may go to the early investors who are like, woohoo, I just got my return, there's my return. Guess what? That used to be what happens when you head to the market. And so you end up waiting for macro market windows as well, where you're waiting for the right window to be on the market. During COVID, when the economy was down, that's not a good window. We would say the window is closed for IPOs. So one of the key causes of the shrinkage was some people didn't go public. They would get bought by private equity, would take advantage of the profits, and that's how they made their return. And sometimes VCs caused it to be delayed as companies could keep getting money that way and didn't have to go IPO for that lump of money and to pay off early investors. Then merger mania. That's another one that took place, and I'm going to dive into it a little bit here. So first, let's go take a look at the effect of venture capital. Look at this. These are the unicorns, and the unicorns is a startup, and I think the unicorn definition started being used in like 2012, 2013 to be exact, and that is a startup valued at $1 billion. And as you can see, since 2020, just since right here, we've created 1,315 unicorns. Those are billion-dollar private companies, mostly created by venture capital. Some of them have private equity investors at this point. So you can see that the blue is North America, which is basically the United States and a little tiny bit of Canada. And then the green is the rest of the world. So you could say that the US is the majority of it. And then after we come out of COVID, back here 2023, we're right back where things were 2018-19, even a little less than that actually, a little bit below that. So in other words, here's a perfect example. All these unicorns, they're not on the stock market. These are private companies. So you have 1,300 private companies that are out there with these giant valuations, some profitable, some not profitable, some building up for the future. So that's a perfect picture of how in the old days before all this happened, in the 60s and 70s, these companies, probably 90% of them, would already be on the stock market. Then you go to the next one. 1996. Remember I said 27 years? Boom. It was investment rules were changed and these huge funds could be formed because the securities regulations were modified in 1996. Boom. Remember that data point we had on the front where it was the peak of 8,000? As soon as they changed this, there were other ways to sell your company or make a mountain of money in terms of a monetization event. Boom, securities laws changed and actually changed the number of companies that would be public. Then, check this out. So how much was the change, Biz Doc? How much of an impact did the private equity and venture capital community and the securities laws changed in 96, how much of that had an impact on capital availability? 2018 report said that the venture capital and PE was 5x the capital availability available through IPOs. So guess what? You're creating unicorns and not everybody is going public. Some do to get there and to do the final monetization event, but 5x the capital is created means a lot of these companies didn't have to go through this and something else happened. IPOs going back, Sarbanes-Oxley was a whole new set of regulations made to protect investors and to make sure that companies were doing the right things to go public, but those regulations were expensive. You had to hire law firms, auditors, a lot of people. So making them expensive, there was a ton that you had to do with your company in terms of professional services to get ready to go public. It was difficult. Sometimes you wouldn't pass the Sarbanes-Oxley standards and tests, and you had to go through all of this stuff, and it took about a year to go public. So it also was more difficult to get to that money than it was to this money. And of course, there's 5x more money on this side of it. There you go. But long-term wealth creation can happen once you're public because we all know what happens on the stock market. You keep growing until like last week, Alphabet, $2 trillion company. Took all those years to be a $1 trillion company, and I think it was 20 months later, or a little less than that, they're a $2 trillion company. That wealth creation is driven by the stock market. Then, well, that explains why some of them didn't go public, but how did some of them disappear? Merger mania. Big tech has acquired 870 of the companies. Amazing. And I dug this up and found this chart, which is very interesting. Google Alphabet has acquired 263. So some of the companies disappeared from the stock market because Pac-Man, and here's the 5 Pac-Mans, ate all the dots. Google ate 263, Microsoft 255 companies, Apple ate 133 companies, Meta ate 101 companies, Amazon 98 companies, and NVIDIA, who's been around for a while, but their recent run of the last 3 years, which has been amazing, they've only eaten 25. But together, just these companies have acquired 870 companies off the stock market. And this is all tech. I haven't even gotten into like big consumer goods, conglomerates, all the defense contractors that consolidated, telecom that consolidated. I once upon a time worked for Sprint. Sprint's now inside T-Mobile. They're gone. So all this consolidation, I'm just talking tech. There's all these other segments that are out there. So mergers also took a lot of small companies right off the stock market. And that is where they all went. So when people want to know, hey, there was once upon a time 8,000 companies on the stock market. Now there's barely 4,600 and something. You can throw your friends and say, you know what did that? Private equity, venture capital provided a lot of capital out there, so they didn't have to go public. Sarbanes-Oxley made it more difficult to go public, and big tech and corporate consolidations gobbled up the rest, and here we are. With fewer companies and all of this money in our economy, there's also what's called the bid-up effect, where there's a bucket of money out there that wants to make investment for your IRA, your 401k, or yourself, or if you're part of Wall Street Bets and you're out there doing that game, guess what? There's only so much to choose from, and that actually bids up the individual equity prices of the ones that are there because there's a large supply of money for only so many of them. So that's also interesting too. And then also, value goes up when we print a big stack of money, maybe $2 trillion worth, handed out during, a pandemic, and then we create an inflation effect on the asset values. But hope that answered your question. Where'd all they go? That's where they went. I'm Tom Ellsworth, the Biz Doc, and I hope you enjoyed this. I'll be back next week with another case study. And if you like this one, check out one of these from the Biz Doc archive. Until next time, I hope I left you better than I found you.